And everyone, getting to some of those tech earnings that Inez was mentioning, let's kick it off with Alphabet here, missing Wall Street estimates for the third quarter as slow revenue growth and a dip in YouTube advertising weighed on the search giant. But with its scale and diversified tech portfolio, is it positioned to weather disruption in the digital ad space? Joining us now to discuss and weigh in, we've got RBC Capital Markets Internet Equity Analyst Brad Erickson. Pleasure to welcome another Brad into the chat here. So Brad, first and foremost, your takeaways from Alphabet here, especially considering some of the different parts of the business. I mean, this is still 79% an advertising-based business here.
Yeah, that's right. And I'll do my best. Brian, I got to tell you, I'm still reeling from how on earth you spend $48 at Chipotle. But let's talk Google, since that's what I'm here for. It was a tough quarter all around. They missed top and bottom line relative to the street. And then I think the Q4 commentary was particularly ominous. They spoke to seeing basically a broader pullback in ad spending within that business. And then surprisingly, there's no layoffs at Google. Apparently, they're actually adding employees half the rate that they have been. So it's a little bit slower. But I think that caught people by surprise as well. And so you're seeing earnings estimates in particular come down enormously here this morning, and obviously reflecting that in the stock.
I want to ask about YouTube in particular. Is there something that Google can be doing, Alphabet can be doing with YouTube that it's not doing? Or is it just sort of subject to competition from TikTok, for example, plus the macro environment? And are there more levers it can pull there?
Yeah, I mean, I think there's a couple of drivers, right? First and foremost, YouTube, because it is a social platform and does rely on third-party measurement through IDFA, right? It was exposed to the Apple downturn. So there's absolutely been headwinds there. And I think, they've somewhat abated from a year-over-year perspective, meaning we've lapped them. But I think there's probably still a bit of leakage going on there. And then, sure, competitively, we all know TikTok over the last year or two has sucked a lot of the oxygen out of the room for those in the social space. And so, one of the comments management made last night on the call was someone asked about whether the mix shift they were seeing, the short form video, the YouTube Shorts, increased usage, if that was incremental to YouTube or if it was a mix shift. And they kind of insinuated that it was a mix shift. And so that's your sort of evidence that TikTok is continuing to have an effect on that business. Going forward, Performance Max is their product, which basically, if you don't know where to spend, be it search or YouTube or elsewhere, Performance Max is an AI tool that allocates your spend automatically. We do think that's going to be super important as they start layering spend into YouTube Shorts, YouTube ad spend, monetization in YouTube Shorts, but that's still early days. And so that's probably not going to show up in the numbers till next year.
Brad, how severe do you think these cost cuts will be at Alphabet?
Well, to date, I mean, like I said earlier, we're not really seeing evidence, at least directionally, of cost cuts, right? Like they said, they're going to, from a net ad perspective for headcount, they're going to cut that in half. But that means they're still adding roughly 7,000 employees quarter over quarter, which is a lot of heads. I think as we get through to next year, the CEO kind of reiterates some other comments previously around trying to squeeze out more efficiency on a per head count basis. So clearly they're pointing to more cost efficiencies there. But yeah, I think people are a little concerned that hey, these guys are seeing a downturn. They're speaking to it qualitatively here going forward, and that's not being reflected in the cost base. Now, flip that, maybe let's just take devil's advocate for a second and say that's positive. It could reinforce the view that maybe Google is just viewing this as a temporary, transitory type of thing. A lot of confidence in the business longer term, and they don't need to go there. So you could argue it both ways, but certainly for today and where margin estimates are going, it's a negative.
And on the hardware side, it doesn't seem like they could even afford to lose out on an install base that they would see come in from the number of phone devices or smartphone or handheld devices, even with a waning PC market, even with some of the slowdowns in ad. It seems like they would need to continue to produce regardless of what the margins would look like on that side of the business.
Yeah, I mean, hardware is obviously a tertiary part of this model, but it certainly popped up or flared up, I should say, a little more in the quarter, with the launch of the Pixel 6a. Obviously, that has a normal cost of bill of materials and gross margin profile for a hardware product, which is substantially below the ad revenues. And so that weighed on the model to some degree in the quarter. But, I don't expect that to be sort of a sustained headwind as we move forward here. So,
RBC Capital Partners Internet Equity Analyst Brad Erickson, good to see you. We'll talk to you soon.
You as well. Thanks.